This is the Equity Management Academy Weekend Podcast for May 28, 2022. Gold, grains, and raw materials prices to skyrocket. Summary. As the Fed begins to move to raise interest rates, the economy is going to slow down. Until we can replace the lost grains in raw materials from Ukraine and Russia, prices are going to skyrocket. We also have an energy crisis as Russian oil and gas comes off the market. We appear to be near a major bottom in commodities, digital assets, and precious metals. Fundamentals. As the Fed begins to move to raise interest rates, the economy is going to slow down. In California, to fill your gas tank can cost more than $6 a gallon. It is the highest it has ever been. Inflation is here. It is almost a tax on economic activity. We are coming out of a pandemic with short supplies because everyone reduced their inventories as a result of the pandemic. Demand has been much higher than expected. Then Russia invades Ukraine and eliminates about 30% of food production in the world. Now we have a geopolitical crisis that is wondering where the supply situation is, worsening the supply chain situation. We have shortages of zinc, palladium, and the price of food is rising quickly. Soybeans are at $17.59 a bushel, and it looks like soybeans are ready to take off to a whole new level. Beans in the teens, $20 soybeans are in the realm of possibility. Wheat reached $13.63. Wheat Ticrium Wheat Fund, wheat came back down and now is roaring back up in a new cycle. Wheat will probably reach $14 or $15 a bushel. And the fundamentals support that technical analysis. Until we can replace the lost grains in raw materials from Ukraine and Russia, prices are going to skyrocket. We also have the energy crisis as Russian oil and gas comes off the market. The Fed's dilemma. Amid all these pressures, the Fed cannot raise interest rates without pushing the world into an economic recession. The damage had already been done as the 10-year note rose from 0.33% in 2020 to more than 3% now. The move has already affected weak borrowers who use the free money provided by the Fed to build a bubble in various markets. As rates have exploded, we have seen a tremendous deleveraging in digital currencies. Once the dust settles, the survivor of the digital asset realignment will be Bitcoin. Economic landscape. We are living in a complex time. In some areas we have stagflation, in others inflation, in others hyperinflation, such as in food, commodities, and energies. We appear to be near a major bottom in commodities, digital assets, and precious metals. It is offering tremendous opportunities, since this volatility allows you to invest when many assets are at bottoms. Many markets appear to be getting ready for a major move to the upside. If you know how to monetize this crisis, you can greatly improve your financial situation. To taper or not to taper? The Fed balance sheet is around $9 trillion. The Fed is talking about tapering, taking money out of the system. In this environment, we do not see how the Fed can do that. The Fed is behind the curve. The market is dictating the interest rate. The 10-year note is already way up in the past couple of years. The Fed does not control that rise. Standard deviation and reversion to the mean. Gold. Gold Spider Gold Trust ETF GLD completed the daily target of 1861 for May 27, 2022. The weekly variable change in price momentum indicator, sell one level of 1867, was also completed. Gold has completed a reversion to the mean and has met the daily pattern. When the daily pattern is completed, it goes neutral. There is resistance now in the gold market. The artificial intelligence in the VCPMI identifies the pattern and levels where it best to trade. The extremes above sell 1 and sell 2, or buy 1 and buy 2. The mean price for the day, week, month, or year. Gold closing below the sell 1 level begins to identify the reversion to the mean. Silver also made a new high of 22.47, meeting the daily sell targets before coming back down, which activated the daily short targets of 22.15 and 21.94. If you are long the NASDAQ, we recommend that you take some profits hedge or lock in profits. VCPMI Artificial Intelligence. The VCPMI helps eliminate the emotional input into trading. You want to use a robotic approach to eliminate that emotion. The VCPMI can replace the emotion of execution so you can focus on highly probability trades. It is not right 100% of the time, but it provides you with entry and exit points for high probability trades in the 90-95% range. You can use the VCPMI for day, swing, or position trading.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, ematotrade.com, or listen to any of our previous episodes.
Are you looking
Patrick MontesDeOca with Live Trading Talk here for May 31st, 2022. We have a little bit of volatility coming back after the holidays. Markets are adjusting to the day off that we had in the U.S. on Monday. So we're going to let the volatility just trade itself and identify for us some high probability trades for day trading and for swing trading. We had an opportunity this morning to activate a couple of trades in our live trading room here for day trading purposes. One of the things that I want to emphasize for those that are just joining me here is that we are primarily short-term traders. We are day traders and swing traders, and the focus of the room here is to capitalize on day trading opportunities that are provided basically through the gold market, silver market, through Bitcoin, NASDAQ. These are the primary markets that we're concentrating on, and using this algorithm, which is basically using standard deviation and mean reversion in these markets, and it is using the application of the VCPMI, the variable changing price momentum indicator. And what you can see here basically is the signals that were provided at 5:53 a.m. We bought 2 silver at 21.72. We bought 2 gold at 18.51. The market went in our direction, and we recommend trailing stops when the position begins to enter into a profitable range. We sold those 2 silver at 21.86. and we sold the gold at 1858. And this was, so far, the day trades that we have done for today. And what I do here is basically I execute the signals that are provided by the variable changing price momentum indicator. I wanted to share the report that we published in the Associated Press with regards to the current fundamental situation that seems to be building up to be potentially explosive as we move into the summertime, particularly for grains. We are in a corrective pattern since we made the highs here recently of 1284 on wheat, and we're down to about 1113. So we've been in a corrective pattern where the market basically has anticipated the damage or the cut in production from the region, particularly from Ukraine. Ukraine and Russia are responsible for about 30% of production, of wheat production, grain production, particularly to the Eurozone. And what you see here is that the market has come down into this long-term uptrend channel that we've been building since the breakout occurred when Russia invaded Ukraine. We have seen the market discounting damage, except that we didn't know at this point what the damage was going to be. And so the market consolidated, and now it's looking to break to the upside because the damage that we're looking at potentially can be devastating for world food supplies. There's a lot of rhetoric right now from Russia allowing certain grains to be coming out of the Black Sea, but here's an example that we are depending on Russia for world food. So this is a critical situation that is evolving, and it basically confirms that the Russia conflict is affecting the world in more ways than just energy prices. And as we move into the summertime and we begin to see the pipeline of these products decline and demand not waning anytime soon, there's a possibility that we could see some spikes, obviously, in prices, unless we begin to see demand destruction as a consequence of all these high prices. We are going to see much higher prices down the road. Crude oil, which is one of the products that essentially has been drastically reduced from the region, and there's talk about an oil embargo with Russia by the end of the year. And so we're looking at the crude oil prices reaching already 130 not too long ago. The same chart applies for energy prices that we consolidated from a high of 130. And now we're beginning to see the damage is of severe consequences, particularly if we have an embargo against Russian crude oil. It stands to basically cause massive increases in crude oil, energy prices, natural gas, until we can find some alternative to replace the Russian crude oil. So we have a lot of black swans developing here fundamentally in the physical market, in the availability of obtaining supplies. And even though we may have the supplies available, the problem is transportation, which is affecting globally as a consequence of not only diesel prices, excuse me, almost doubling the cost of truckers that are responsible for moving whatever product is available to the market. It's very difficult to obtain the basically tools necessary to keep maintenance going for these trucks. So we're running into a logistical problem as a consequence of this tremendous supply chain disruption that we have coming out of Russia and coming out of the Ukraine. It's not talked about enough. Even the war itself has been kind of watered down, so to speak, from the media. But, we don't want to talk about what's going on over there because Mr. Biden is negotiating with the Saudi Arabias and Venezuela, basically, on how to get some of their oil, as opposed to allowing some of the production to take place here in the United States and open up the pipeline. I mean, the United States can be self-sufficient in producing crude oil. It's one of the largest producers. It has one of the largest reserves in the world. But the government policies don't seem to be in favor of basically taking control over the production of crude oil and being able to manage, you might say, this incredible tax that is being applied to Main Street. The price of crude oil going to $200 a barrel, which is possibly what could happen here, is causing massive economic disruptions. Not to mention the fact that interest rates have gone literally from almost zero interest rates to above 3%. We have a recalibration that's taken place in the system, and we yet really don't know the consequences, you might say, particularly of this deleveraging that is taking place as a consequence of interest rates increasing. So we have yet still to see the effect, you might say, that this has had to Main Street, to the economy. And more than likely, I believe that we're going to be looking at the Fed's putting a hold, you might say, on raising interest rates, because it could literally break the back of the U.S. economy and the world economy. When you really think about interest rates going up, for every 1% increase in interest rates, you're looking at a additional expenditure of the Fed in terms of interest expenses of over $300 billion. And so the pressure is not only for Main Street, but also for the Feds themselves in terms of how are they going to pay this debt. So the pressure definitely is beginning to be on the Feds in terms of what policy are they going to apply, and how is that policy going to affect the financial markets, short of putting the economy into a recession. So the markets have anticipated about 2 increases by the Feds of about 50 basis points each. And so that's about 1%, a 1% increase that I believe the market has factored in. Now, the question is going to be, how are this increase in interest rates are going to affect the economy? How is it going to affect the economic growth? Is it going to slow down? Is it going to basically increase opportunities? The path of least resistance that we have basically in the psychology is that interest rates are going up. They already have gone up. This is the dilemma that the Feds are dealing with. Interest rates on the 10-year note has already gone up to 3% without the Feds doing anything. We're up to 285.90 here. We saw a correction down to about 272 last week. And it looks like we're going to be trading possibly in a range of about 275 to 3% yield. Under 275, it puts the stock market undervalued, particularly the S&P. And what you see here is almost a head and shoulder top on interest rates, and it looks like the top was about 316. So we're in this range of about 316 to 275, and it looks like we might be trading here for a little while. But if we do break either one of these levels, breaking above 316 puts into the picture about 350 to 375 on the 10-year note, and that's pretty recessionary. That's pretty bearish for the economy, obviously, because the Feds are going to have to raise more than they expected. And so the question is this rise in interest rates going to slow down the economy? And how is that going to affect basically commodities and financial products? But what we see here is that we've seen a potential top in interest rates, and so the market is going to be trading in this range. Breaking below 275 is extremely bullish for the markets. And I think that as we move into the summertime, as we move into the next 2 quarters here, the economy is going to dictate really what the Feds are going to do and what the markets are going to do. And so far, it looks like there is a possibility that interest rates are going to be coming down, and that potentially we have seen some kind of a short-term top on inflation, possibly correcting into July, August, and then we're going to see the numbers as we come into the summertime.
let's go back to the markets here. And I didn't have much of a chance here to review the data for today, but you can see the market trading around the average of standard deviation for gold weekly, daily at about 1859, and we're looking for a close above 1859 to continue the uptrend all the way up to maybe 1891 for the rest of the week. The area that we have here today in blue is basically recommending to add to your long-term position or to your longs from these levels. It looks like we have seen the low come into gold at about 17.85 on May 16, and we are reverting from this level potentially into the 1968 target, which is the Fibonacci 61.8 golden ratio retracement. The markets are recalibrating here after the holiday, and we have ended basically the month of May, and let's see what June brings, but I think that the market is making some kind of a bottom here, and we want to trade from the long side. In the meantime, my friends here, I want to wish you a very good week. Have a great week. Have a great trading day. We'll talk to you soon.